Hey guys, welcome to CT Guides. My name is Theo, also known as Tao Cruz on the CryptoTraders Discord, and today we'll be doing a lesson on spot versus futures trading. We'll start with rates and premium. So for spot, the rate that you pay is the market price, and that is determined by the current supply and demand for a token. Whereas for futures, you do pay the current market price, but on top of that, there's also a futures funding premium. To add more clarity to the futures funding fees, I've also included this chart. So we can see when the futures price is greater than the spot price, there's a positive funding rate, and that's going to imply that any longs are going to pay a funding fee to anyone who's short. However, if the futures price is less than the spot price, then there's currently a negative funding rate, and that implies the shorts are going to be paying the funding fee to the longs. We'll move on to ownership now. So with spot, you own the cryptocurrency you're trading, and you can withdraw this crypto from the exchange to your personal wallet for utility elsewhere. As with futures, you don't actually own the cryptocurrency you're trading. You're just pretty much speculating on the future price movements to make a profit, and it's typically done with leverage. Moving on to leverage now. Spot trading usually doesn't involve leverage. You have to have sufficient funds in your account to cover the full price of the cryptocurrency you're trying to purchase. Whereas with futures, it typically does involve leverage, and it allows you to control a larger position with a smaller amount of capital. That's a double-edged sword though, so it can amplify both your gains and your losses. Moving on to risk. The risk in spot trading is limited to the amount invested in each trade. However, spot prices can be volatile in the crypto space, especially with small caps and meme coins, and that can lead to large price swings and large losses, especially if you're not mentally prepared and you exit a position prematurely. Moving on to futures, they do definitely have a higher risk, especially when you're using leverage. And that means there is the potential for you to lose more than your initial investment. I'll speak to the purpose of each now. So for spot, it's typically used by traders who want to buy or sell cryptocurrency for investment, to use it in transactions or to speculate on short-term price movements with limited risk. For example, you're trading a risky token that's very volatile, and you don't want to use leverage. Now for futures, it's commonly used just to speculate on price movements, sometimes also for hedging, and it's really just used for getting exposure to a cryptocurrency without actually wanting to own the underlying asset. You're essentially just trying to trade it to make money, whether you're going long or short, and then also, using the benefit of leverage to, hopefully amplify your gains, which is the greatest benefit that futures provides to us. So I'll wrap up here with a conclusion and do a quick review of all the concepts we spoke about today. I'll start with rates and premium. So the spot rate is equal to the market rate, whereas the futures is the market rate plus the premium. And now there can be either a positive funding premium or a negative premium. For the positive, the futures price is greater than the spot price, and that means that longs on the futures are going to pay shorts. Conversely, if the futures price is less than the spot price, that means shorts are going to pay longs on those futures contracts. Moving on to ownership. Now on spot, you do own the underlying token that you bought, whereas with futures, you don't. It's really just for speculative purposes. And the greatest difference between the two, is that with spot you can actually take it off the exchange as you use it for utility elsewhere. Whereas futures, any contracts you buy on there are stuck on the exchange. you're really just trying to, speculate on the price and make a profit. Speaking to leverage now, in spot there is no leverage. When you buy it, you own it, and then you can use it, wherever you want. You take it off exchange, and it can have utility elsewhere. But you need to have all the funds available. You can't borrow. Whereas on the other hand, futures does have leverage, and you can borrow. That's a double-edged sword in the sense that can both amplify both your gains and losses. Moving on the risk, spot is generally low risk. When you buy a token, you own it. The worst that can happen is you lose 100% of your initial investment. Whereas with futures, there is a potential for you to lose more than your initial investment. And we'll finish up with purpose. So for spot, the general purpose is that you're buying it for an investment. You want to hold it for a long period of time. Maybe you want to take it off of the exchange and put it on like an actual physical ledger, or you want to transfer it to wallet off exchange. So you can use the token elsewhere. On the other hand, futures are primarily a tool of speculation. You're using it to speculate on the price movements by going long or short, and then using leverage to amplify your gains. That's it for today's lessons, guys. I hope you enjoyed it. If you have any questions, send me a message on Discord or leave a comment below. And we'll see you on the next one.